member of MEIA. I think that's great for everybody. So really looking forward to seeing MEIA expand and be able to work with more and more companies in a kind of longer process over that valley of death, because that's one of the biggest issues. So that'll really be a wonderful addition. Let me see if I can figure out how to share my screen. Let's see if I can get it to work. I want it to be. Well, try this.
It's coming. It's coming.
Yeah, but now I need to get. There we go. Okay.
There we go.
Are you able to see the screen?
Yep.
Good. All right. I can see it too. So, what we're here to talk about today is angel investors and who they are and how you find them. So I'm going to start with just a little bit about me, because usually I say this presentation is about you, but in this case, the presentation is actually about me and how to find people like me who are going to become your investors. So my personal journey, like a lot of angel investors, is pretty complicated. I started off as an energy engineer. I did not go to University of Maryland, but I grew up in Maryland. I grew up in Randallstown, near Baltimore. Both of my parents went to University of Maryland, but I went to Northwestern. Sorry. And then I got my MBA at UCLA, and then I got a master's in energy policy at University of Tulsa. I've worked at a number of big companies, including a long time at Kobe Steel in Japan, where I did computational fluid dynamics, and came back to the US and got involved in startups, mostly in the IT space. Did that for 25 years. I built and ran these two startups, and then 3 others that weren't as successful. And in the middle of that, I also transitioned to doing angel investing in other people's startups, and then also being a mentor to help founders kind of understand what investors are looking for. So I'm part of 2 angel networks, and I'll talk about what these networks are and how to find them and which ones are going to be suitable for you in a bit. But the ones I'm involved in, one very applicable to a lot of things going on at MEIA, is called Chemical Angel Network, CAN for short, or Chemical Angels. And we invest in chemistry and materials. Half of that tends to be life sciences, and the other half tends to be sustainability. We have 70 members across the US, mostly PhDs in chemistry, a lot of people who are VP or project leaders at places like Dow and 3M and BASF and International Flavors and so forth. So you really get in front of the people who understand your what you're doing. Separately, I'm in another group called Tech Coast Angels, which is the main angel group for Los Angeles, with 400 angel investors who are looking to invest primarily in startups in the LA, Los Angeles ecosystem. And I'm on the executive committee of that organization. I've been a member since 2009, so I've been doing this a while. I'm also a mentor at MEIA. I really like to be involved with clean tech startups. I'm at Clean Tech Open, VentureWell Spire program, UCLA, USC, and a few others that are more general. I've done 50 individual investments, and I'm also in 7 member funds. Each fund does about 10 investments, so a total of about 150 investments. My individual ones tend to be focused on energy and climate tech, because that's where I'm interested. That's my background, where my passion is. So here's 10 particular companies, that early stage companies that I've invested in as an angel investor in the climate tech space. Okay, so let's start with what are angel investors. And the best description I can give is college football versus professional football. And I'm actually a Ravens fan. I started off as a Colts fan growing up in Baltimore, and now I'm a Ravens fan. So last week or 2 weeks ago was extremely painful for me. But the main difference, it's the same game. We're looking for the same things. We are investing in the same sort of companies, but we're at different stages. And I think the main difference is, just like the college game, angel investors are investing for themselves. We're volunteers. We're doing it because we enjoy it. We're doing it because we want to make money ourselves. Whereas VCs are companies, they're professionals. People who work there get paid. They are doing that as full-time jobs. And that is primarily the main difference. So an angel investor is simply an individual invests their own money in startups. We are venture investors. So I call the venture investment community is angels plus VCs. And we work the same way. We're looking for the same thing. It's different from private equity investment. It's different from real estate investment. The way it works is we are looking for a big return from an exit. We're not looking for dividends. We're looking for an acquisition or an IPO. 10 years from now, that is going to be 10 times, 100 times worth the money that we put in. And it's very risky because 90% or more of the things we invest in are going to fail. So we need a 10x return just to break even on the one that succeeds. But we're similar to VCs, but it's our money, not the VCs. It's not their money. They're getting paid by real estate, by retirement funds, by investment companies, by private offices, by corporations to invest for them. So that's a job. They put in some of their own money, but primarily they're getting paid full time to invest other people's money. We're investing our own money. However, we're investing checks of 25K. They're investing checks at $10 million, which means we're going to be at different stages. At the time when a company is looking for $10 million, you don't care about our 25K check. At the time when you need 100K or 500K, the VCs are just like, well, you're way too early for us. Come back when you need $10 million or at least $2 million. So we're going to be the earlier investor. They're going to be the later investor. And keep in mind, it's a part-time activity for us, not a full-time job. The implications, as I said, we're going to invest earlier than the VCs. And you're going to need to find a lot of us. With the VCs, you can find maybe 2 of them that'll write 2 checks and you're done. And it sounds easy. It's not that easy, but you only need to sign up 2 VCs. Just to raise 500K at 25K per check, you need to find 20 angel investors. And if your success rate is 2 out of 100, what is that, 400? It's like 4,000 people you need to find just to get 20 checks. So it's not easy, but there are some shortcuts that we'll talk about. So who are these angel investors other than me and my friends? So the myth is there's a bunch of rich guys out there that you send your idea to, and they're going to write you a check for $2 million. So that sounds nice. And there are a few what are called super angels that have hundreds of millions of dollars that they will invest a couple $1 million in things. But they get so many pitches that they have a full-time staff running it. So in the end, they are essentially a VC fund that runs like a VC fund, except it's one person's money instead of 10 companies' money. So that's not your typical angel investor. Your angel investor, reality is somebody who looks like me or somebody who looks like this. And we are industry professionals. We worked, maybe retired, we had a career. Now we have some extra money in the bank. Some of it we put in real estate, some of the money we put into, S&P index funds, and some of it we want to put into startups because we enjoy working with startups, and hopefully that is a good investment too. So tend to be people in the industry. We tend to be startup supporters, small individuals. We still need to make a return. Money is coming right out of my retirement account. But legally, we have to meet the SEC requirements. So not anybody can invest. There's a few ways you get qualified, but the main one is if you have $1 million in assets, not including your home, then you are allowed to be an angel investor. And we tend to write small checks. There's a range. There's an exception to everything that I say, but the sweet spot tends to be 10K to 25K. Okay, so where are you going to find angel investors other than presentations like this? So the myth is you're going to get some lists, some email lists, and you're going to just spam everybody, or you're going to go into LinkedIn and look up angel investor and send a message, some template message to 1,000 people, and you'll get 20 good responses, and then you're done. I get a lot of outreach on LinkedIn. and a lot of email spam. I don't know anybody pays any attention to it. They're usually, I'm not the right person. Their pitch isn't very good. And somebody I don't know, somebody's randomly sending me a pitch saying, "Hey, I'm building a startup. Will you invest in me?" And my answer is usually, "No, sorry." So the reality is, especially at the earliest stages, it's going to be people in your network already. It's going to be people who are industry professionals in your industry. They understand what you're doing. This isn't just some random guy on LinkedIn say I invest. It's somebody who's in your industry who understands what you're doing, why you're doing it, what you're building, and it just makes sense. They're probably going to be investors who specialize in your field. It's not going to be angels who invest in gaming. It's not going to be angels who invest in fintech or blockchain or consumer product goods. It's going to be investors who invest in energy or chemicals or something like that. But there's also angel groups, and we're going to talk about angel groups because that's going to be your shortcut to finding a lot of people real quick. So within your network, you have mentors. They may be investors, or they may introduce you to investors. You have advisors, same thing. So these are people you want to have part of your team, but they're also going to help you find investors. Customers, actually, customers can be your best investors because they want your product. They want you to build your product. They need your product. So, and they see the value in it. They know how important it is. So they can actually become your, so they're not actually angel investors. They're more like strategic investors, but they can become your first round of investors. And it may be, especially if your customers are not big companies, but smaller family-owned businesses, that may be the owners may become your investors as well. Same thing, distributors and partners. Everybody you work with who understands what you're doing, why you're doing it, why you're so much better than anything else on the market, ought to see why this is a great business opportunity as well as a need for their business. So they can become your investors. But when you go onto LinkedIn, what do you want to reach out to? Our industry experts, our retired executives from your industries, our founders of startups that have already exited. They're the people you want to get advice from anyway. So reach out to them. Don't start with, I'm looking for investment. Start with, I need advice. I'm building a startup, doing this. I could use your advice. Can you spare me 15 minutes? But you have to be sincere about that. I get a lot, and I spend my time 15, 30 minutes. It usually goes on for an hour. We talk about a lot of things. We get to the end and they say, "Okay, how much are you investing?" I'm like, no. I thought we were just having I thought you wanted my advice. So you need to be sincere about it. And like, really, these are people you want to get advice from. These are people you want to do customer interviews with and industry expert. Use their advice. And then if there's a connection there, if they get what you're doing, then you can say, "Hey, we're also raising a round. Is that something you'd be interested in? Do you know people who'd be interested in this? Does it make sense?" And build up that way. So don't just go out and say, "Hey, I'm looking for investment. Will you send me a check?" All right. So that's a lot of work, and it's always going to be a lot of work. Fundraise. I tell founders you have 3 full-time jobs. Number 1, you have to build the product, and that's a full-time job. Number 2, you have to sell the product, and that's a full-time job because you can't hire a head of sales at first. And number 3, you actually have to raise money to build the company at the same time. And you think, "Oh, I'll just do that for a month. I'll get the money, and then I'll have to worry about it for another couple of years till I do the next round." It's a full-time job, just like building the company. You're going to be doing it. Your raise is going to take 6 months. Sorry to tell you that. And as soon as you're done, you need to start prepping for your next round while keeping your current investors happy. So it ends up being a full-time job. And if you have a family, now you have a 4th full-time job. So yeah, nobody ever said you were going to get a lot of sleep as a founder, but hopefully it's fun. So angel groups are one way to get in front of a lot of people at the same time. And I strongly recommend that is the best way of getting in front of angel investors. So there's all kinds of different angel groups. So like I said, I'm a member of TCA, which invests in anything that has some connection to Los Angeles. And every city you go to, there's an angel group there. So there's Brooklyn Angels, there's New York City Angels, there's Rocky Ventures in Denver, there's Tampa one, there's Desert Angels and Phoenix. There's probably 100 of these organizations. You should look for the ones that are in Maryland and Washington, Virginia, and start becoming friends with them. They will probably be heavily tied into the defense industry because that's the main industry in your area. But you never know, and you definitely want to build up those relationships. So local groups are the first way to start. There's also sector groups. So in clean tech and in chemistry and materials, we have chemical angels. If you're in life sciences, there's life sciences angels, there's climate angels, there's a bunch of these organizations. You want to be pitching to them. You want to be making friends with the members of those organizations to kind of help you get ready to pitch to those groups. Then there's university affiliation. So HBS Angels is huge. It's one of the largest angel groups in the country. Princeton Angels kind of copied them, similar thing. I don't know much about it, but apparently there's an organization called Dingman Center Angels, which is University of Maryland. So a lot of you, if you're in grad school, you may have started in a different university undergrad. You may have people working with you or at Johns Hopkins or somewhere else. And all of these schools have their own angel groups. Now, that's separate from the venture groups that are tied to the universities, which you probably aren't ready for, but look for the angel groups that have some university affiliation. And then there's impact groups. So Golden Seeds invests in women-founded startups. Gain Angels is for the LBGT community. Swan is impact investment. So, whatever connections you have, use it. These are people you want to talk to. And then there's just generalist one, Keiretsu. I'm not a big fan of Keiretsu because they charge you to pitch to them, which I don't think is something they should be doing, but that's the way they work, and that pays for their operations. They're the only ones I know that do that. And then Band of Angels is a nationwide group, and there's a couple of other nationwide groups as well. So a lot of different angel groups. Use whatever connections you have, whatever one seems to fit what you're doing, and apply to those groups. There's a whole list at Angel Capital Association, and you can probably, web is great. Just do a search. You can probably find, just look for, Virginia Angel Group. You'll probably find a list pretty quickly. So how do you pitch to them? What are we looking for? And again, this is where I usually hear the wrong story, especially from early startups. And this is what I work with companies with in the accelerators is how do you pitch to angels, and same thing actually to VCs. And what I usually hear from early stage startups is, look how wonderful a product we have. Look how wonderful our invention is. And our answer to that is, unfortunately, I'm sorry, so what? When you're pitching to us, you are doing something. You are trying to sell us stock in your business. Why are we going to buy that stock? Because it's going to be worth something in the future. So just like when you talk to customers, you're trying to show them why your product is going to solve their problems. When you talk to investors, you need to show them why stock in your business is going to make them money. And that's what it comes down to. And it's not your profits. We don't get any of those profits. You're not going to have any anyway, but we don't get any of the profits. So the only way we make money is our money sits in your bank, you use it, whatever, until the day when the stock in the business is sold to somebody else. When that's an acquisition of the company to a bigger company, or you do an IPO if you get large enough, and then the shares are tradable and we can sell them. Until then, it's just a line in a spreadsheet on Excel or in Carta. So our money is sitting there. We don't get interest. We don't get profits. We don't get dividends. We can't resell it. It's dead wood until the day when you have an exit. So what we want to hear is you're going to have a big exit as soon as possible. And that's going to get us excited. So the pitch is not about the product. I mean, obviously, you need to talk about the problem and your solution, but that is just one piece of it. So what is the business? It's not even what is the product. What is the business? Who are the customers? How are you going to find them? How is this going to solve their problem? That's just the first piece. Then, okay, you have a product that people want, but still 99% of early stage startups are going to fail. So why are you the 1 out of 10 that's going to succeed? How are you going to do that? How are you going to get to $100 million? How are you going to beat the competition? How are you going to protect yourself from copycats? It's tough. and you need to show that you know how to do that. And then lastly, the one that everybody forgets is you're selling us on an investment. Why is this a good investment? How much does the stock cost, right? How much are you raising? What is the valuation? What's the exit going to be? How do we actually make money out of this? So we need those three components in a good pitch. And if you have all those, then that's your story. This is going to be a great business. Well, you have a great product that's going to lead to a successful business that's going to lead to a fantastic exit that's going to make you a lot of money. That's what you need to tell investors. Typical terms. So angel investors will usually invest in pre-seed into seed round. The VCs will typically invest in Series A and beyond. Now they've started to come down to pre-seed to seed round, but they're making a mistake doing that. So there's usually overlap at that late seed round. But typically Series A and beyond is VCs, pre-seed seed is angel investors. Check size, as I said before, typically 25K range. You may find somebody puts in 50K. Maybe somebody on the board puts in 100K. You may have people asking if they can do 10K, especially in the very, very earliest stages. Angel groups so if you go to Tech Coast Angels, for example, we have a yearly fund. The fund is typically about $2 million each year. We'll invest in 10 companies, so 200K for each one. So you pitch to us and you're successful, you get 200K from the fund, plus probably another 150 from some of the angels. So total will roughly be about 350 from our group. And then this will be one investment out of a total raise of up to $1 million. Somebody seems to not be on mute. Can you
11 and 3.
Can you make sure you're on
Our
mute?
record is the opposite. 3 and 11.
Somebody mute Dung.
Not even 3, 2. 11.
Right, so the sweet spot for valuations are, typically in the 8 to 12 million. So if you're trying to raise on a $25 million valuation right now, angel groups are probably the wrong place. You probably want to be talking to VCs, but you need to be ready for the VCs. You need to have actual revenues. The investment vehicle would typically be, your choices are preferred equity. We like that, but it's a lot of extra work if you're not ready for it. Post-money safe is fine for a lot of us. Some angels say no safes, but most of us are okay with post-money safes or a convertible note. We do not take common shares. We do not like pre-money safes, and we will not take an uncapped note. So there needs to be a valuation on there. So the process to get investment from an angel group, you'll apply online. You go to Tech Coast Angels. There's an online application form. Chemical Angel is an online application form. You'll fill it out. That will get you into pre-screening, where a small group of people will hear your pitch or a shortened version of the pitch and decide whether it seems applicable or not. If you're successful at that, then you do the full pitch in front of the full group. If everybody is interested, your pitch will typically be roughly 10 minutes. If that 10 minutes gets people excited, then we schedule for the people who, you're not going to pitch in front of 50 people. We'll have a smaller group of maybe 5, a subcommittee who's a specialist in what you're doing, and we'll have a 2-hour discussion where we go into all the things that you wanted to tell us in the 10-minute pitch and didn't have time for. So your 10-minute pitch is very similar to elevator pitch. The idea is to get us excited, not to get us to sign a check that day. So it's pretty high level. You really just need to go through kind of the story that gets us excited. Then we'll schedule a 2-hour meeting to go into the details. If that's successful and still interest, then we will spend probably a couple of weeks to up to a couple of months actually going through all the details, talking to customers, talking to industry experts, and really figuring out whether this makes sense or not. Then we finalize the terms if they're not already finalized. Then we have a vote to the fund, and then we send a check. So it's not just like fill an application, get a check. It's an intensive process, but you do get in front of a lot of people at the same time with a fairly substantial check out of it. So the advantage in angel groups is you're pitching in front of tens to hundreds of investors at one time. So you're not trying to reach out to random people on LinkedIn. Out of those, 400 people in Techless Angels, there's probably somebody who understands your particular business. So that's really good. You're going to get people who can be on your board, people who can kind of help you with your various challenges. So we really are value add investors. And as I said before, you'll get investment both from the fund itself as well as individuals. So some groups are only funds, some groups are only individuals, but most are a combination hybrid of there'll be a fund, but then we'll also, people who are interested will also separately invest a larger amount. Challenges though, we're volunteers. I mean, this is, I don't want to call it a hobby, but it's kind of a hobby. We're doing it because we enjoy it. Nobody's paying us to do it. And a lot of us are either working full-time jobs or we're doing other things at the same time, or we're retired and we're traveling. So, as opposed to a VC fund, which is probably on the order of 5 to 6 people working full-time, it's a lot more difficult to keep everybody together because people show up when they want to show up and then don't when they have other things they have to do. It takes time. We don't typically move very fast because, again, it's volunteers. We're doing other things. So you have to be patient. And don't be surprised if you answer one question very thoroughly with one person, and then next day, another person from the same group pops up with almost the identical question. So it can be frustrating. In fact, you can be in a 2-hour meeting and spend 30 minutes going through some of the details, and then somebody else shows up 30 minutes late and asks exactly the same question. You have to do it all over again. So it can be frustrating. Just be patient. That's just kind of the nature of the game. Requirements for angel groups, you need to be a C Corp. We don't invest in LLCs. Ideally, a Delaware C Corp, but it needs to be a C Corp because venture investments where we're looking for an exit need to be C Corps. There's tax advantages to it. LLCs, there's tax advantages to profits-based business, but we're not investing in profits. We don't get the profits. We need to see customer validation. So if you have a great idea, well, yeah, that's what SBIR grants are for. We're not real good at investing in the idea stage. We're looking for something that's already done and you're ready to take it to market or have already started taking it to market. So we're investing in businesses, not ideas or research. There needs to be some sort of intellectual property protection usually in place because otherwise, once you've proven how great it is, your competitors and your customers can just copy it. So it's not about profits. It's about that big company saying that's the most important thing in our industry right now. We need to buy you for $1 billion. And if you don't have any intellectual property protection, they would just make it themselves. For a lot of groups, you need to have a lead investor in place. Techless Angels will be a lead investor. Chemical Angels will only invest when you already have a lead investor. So lead investor is the investor that is the largest investor, also is the one that sets the terms, does the negotiations, works on the documents with you, and then will serve on the board. So it needs to be your largest investor, and you need to have that before you go to the smaller groups and say, well, we're looking for the remainder to fill out our round. And it's about the exit. It's all about the exit. You're going to have to show us that this is a business that's going to potentially lead to a 10x, 100x return sometime in the not too distant future. So almost done here. Angels are usually going to be your first outside investors other than friends and family. But we don't invest for the most part in research. We are looking for something that's already has some sort of customer validation. Find individuals, when you're looking for reach out on LinkedIn, look for people who you want to work with. Look for people whose expertise can really help you, and don't just randomly reach out to everybody who says I'm an angel investor. And then go to angel groups for larger amounts. And I think that's it. Again, my book, To Kill a Unicorn, is all about a startup that's hard tech startup developing teleportation, but there might be some bugs in the system. you can also get my art. I write everything you just heard right now comes out of my articles. I write articles every week or two. So I put some of them up on Medium, and you can follow me on Medium. And then my archive is on my website called pitchingangels.com. So sign up for those, and you'll get a copy of my articles on how to find investors, how to create pitch decks, how to build a startup on a weekly basis. And with that, I think we are ready for questions.
That was perfect. Thank you, DC.
Any questions out there?
Well, there's gonna be
I see
100.
Dan's hand.
I have a question. If Dan, did you have one?
That was my
Wait.
clap emoji, actually.
Okay, sorry. I'm old.
William.
I don't recognize all the emojis.
Yeah, so I might be a little behind the curve on this, so maybe I should be doing some reading rather than asking outright. But on the angel investment terms, there were a couple that I was unfamiliar with. Post money versus pre-money safe, convertible versus convertible notes or uncapped notes.
Right. Okay. So I have articles on all those things up on Pitching Angels, and it is worth reading those because those, when you go out for funding, those are the sorts of things people are going to ask you. They're going to ask you, is that valuation a pre-money valuation or post-money valuation? So you need to speak the language. You need to speak the investment language. You need to know what people are asking you. But just very briefly, the way valuations work is, so let's say you're raising $2 million and your valuation is 10 million. As soon as I put the $2 million in, your valuation then becomes 12 million. And so the price of the stock, which is actually the only thing that's important, will be based on the $12 million number, not the $10 million. So we'll always ask you, when you say your valuation or your valuation cap, is that a pre-money number or a post-money number? The complicated thing is, that's easy math, right? I think we can all do addition. You're raising $2 million. We just add 2 million to it. But when you have safes and convertible notes, it's not at that moment that what you have to do is you have to add up all of the safe money and all of the convertible notes that will get converted that will turn into shares at the time when you issue shares, which is when you have your preferred equity round. And the problem with the reason we don't like the pre-money is it's easy to get burned. So I invested in a startup with a 7 million pre-money valuation. They raised $3 million, so it would be 10 million. But then they raised another 5 million on a convertible note, and so it went to 15. And then they raised another 5 million, and it went to 20 before they actually had what's called a priced round, where shares are actually issued. So I thought I was investing in a 10 million valuation. If I'd been smarter, I would have known it was. I thought I was investing in 7 million. If I had thought about it, I would have known it was 10 million, but it turned out actually to be 20. And they were not worth 20 when I invested in them. And so that was a bad investment. So I would rather, that's why I like the post-money safe. You're going to tell us what the valuation is when I get the shares, and so then it's up to you. If you need to raise more money, then the dilution comes out of your side instead of my side, is what ends up happening. So that's the pre-money versus post-money. And there are safes that are written either way. Now, convertible, so both with safes and convertible notes, the way we like to see it is there is a valuation cap. But there also is an option to just have a discount. So it could be 20% off the next round. And that's fine for, if I know the next round is coming in 3 months, and this is really just a bridge to get there. But with a safe, your next round may not be for 5 years, and telling me, I'm just going to get 20% off of whatever is going to be in 5 years. Well, that's not a good investment either. So some accelerators use them because then they don't need to worry about what the cap is. But for investors who are looking to make a return, it's not really a good investment. So need to see a valuation cap. So I don't want to see an uncapped note. Does that answer the questions?
Yeah, I mean, I like you started with. I need to go do the reading to really get a
So go to my pitchingangels.com site, and I've written up kind of details about all those things.
And William, we'll get you there. Don't worry.
I have a question, if I may. So, DC, thank you very much for this for the presentation. A couple points that jumped out. You mentioned a lead investor in place. So this is while this is in preparation to have angel investors at the same time, and that's one question. And the second is, I'm just concerned about the real cost of bringing in a $25,000 check, as to there is obviously I'm not going to write, I won't be in a position to write a legal document, and we will have to get attorneys and so forth, accountants get involved, and they have hefty fees. So
Yes.
bringing in a 25, that's obviously one, and you would need 20 of those, let's say.
Right.
All these expenses will come out of those, and that and how does that equation work in real life? I guess that's the question.
So the two questions are actually connected in a way that may not be obvious. The reason we're looking for a lead investor is we want one person or organization to do all the negotiations with you and set the terms and create the documents and say, and also do the diligence and say, this is final, invest or not, so that everybody else, you're only going to have to do that negotiation once, and then there's one document that everybody's going to use. So you're not going to raise 25K. You're going to raise 25K plus 25K plus 25K plus 25K plus 200K plus maybe 100K. So the one that's putting in 250K, they're going to be your lead investor, hopefully. They're going to be the ones that are going to work with you to decide, is this going to be a safe? Is this going to be a convertible note? Is this going to be preferred equity? The safe is pretty simple. That's just a template that you can get off the web, and there's very little negotiation needs to be done on it. Convertible note, there's a bit more. Preferred shares, there's a lot. So you probably don't want to be doing preferred shares at this stage. But then once you've got those terms filled in and term sheet written with your lead investor, then everybody else is going to get the same terms. So that way you'll just have to do it once, and then it's the same for me, right? As an individual investor putting in 25K, I don't want to negotiate with you over the terms. I don't want to sit there and figure out what your board is. I don't want to have to call my lawyers to try to figure out whatever your lawyers put together. It's not worth my time. And yeah, it would cost me 10K alone. So it doesn't make any sense. So I'm not going to invest as an individual unless there's already somebody that I trust has done those things with you. And then I'll just accept that that they've done a thorough job, and I can just look at the valuation and say, okay, that's reasonable. I'm in. Does that make sense?
Thank you. Yes.
Yeah.
It's
let me just add one caveat there. Usually at the friends and family round, the very, very earliest stage, there's probably not going to be a lead investor. You're probably raising 100K, 200K from kind of people who are already in your network, people who already know you. You'll just use a safe for that. You'll just give everybody the same terms. And those investors are primarily investing to support you, not to make money. Most of them won't even understand what a safe is versus a convertible note. So you should have a lawyer, and the lawyer will help you draft up the safe, which is it'll take an hour because it's a standard document. And then you just give it to people, and they fill in how much they're going to invest. So that friends and family round typically does not have a lead investor. So it's only once you're trying to raise, the 500K to $1 million or $2 million that you need the lead investor.
Thank you.
Are there other questions? DC, I have a question for you. You talked about exits and when you present in you pitch, how is it best? I mean, you think to present exits? I mean, obviously an exit could be 6-7 years from
Yes.
this point when you pitch. Do you actually say, these are the types of companies that could potentially buy us? Like here are the big players that we compete, but also there's potential for them to strategically purchase us. Like any advice on how to kind of thread that needle when talking about something so far, off in the
Yeah.
future?
Yeah, it's tricky as you said, and a trickier part that you didn't mention is what VCs want and what angels want are a little bit different. So when you talk to the VCs who are kind of industry expert, they invest in companies in your space. Telling them what the exit strategy is going to be is like trying to convince telling your professor about something his research was on, right? They know this stuff better than you. And if you're already at the stage where you're talking to VCs, you already are generating revenue, you've already kind of been validated. You don't need to tell them what the exit strategy is because they know what the exit strategy is better than you. They've probably been involved in half of those exits. So they feel like you're kind of talking down to them if you talk about your exit strategy. However, for angels, we don't know your industry for the most part. We don't know what the typical exits are. We don't know what kind of companies would acquire. We don't know if they do acquisitions. So what you need to convince us of is if you build it and it's successful, there's actually a way for us to get money out of it, whether that be, your plan is IPO, if you expect to get to, billions of dollars in revenue, or that somebody is going to buy your business. Now, if you're in life sciences, like you're working in pharmaceuticals, it's easy. If you have, once you get through FDA approval, you can be guaranteed that a Pfizer or, a Lilly or somebody like that is going to buy you for billions of dollars. So that's easy. If you're in software and you're doing social media, you can be guaranteed that a Google or a Facebook or Apple or something will buy you for billions of dollars. So that's easy. If you're in, say, industrial chemicals, well, who's going to buy the business? Okay, well, maybe it's a Dow or 3M or BASF, but they don't pay a lot of money. So the way to go about it is to say, our plan, and we know everything in your pitch is just it's a plan, and it's probably going to change tomorrow, but this is your plan right now that you're telling us. Is that we expect to get to, say, $100 million in revenue in 7 years. And once we get to, kind of critical mass size, that companies like, like BASF would acquire us. Here's the companies, here's the kinds of companies we would expect to be interested in this business. And here is the deals that they have done recently. And here is the typical multiple of revenues that they pay for companies they acquire. And that multiple of revenues is pretty critical, because what we want to know is we don't want to, if any business is generating profits, can be bought by private equity, but not for a lot of money. And it won't return much to investors. So what we want to know is that you build it and it works, that there's somebody's going to buy you for a huge multiple, that they're going to need this, it's strategic for them. It's not just going to be about generating a little bit more profits. So we want to see who the types of strategic buyers are going to be and how much they typically pay, not in total dollars, but in multiple of revenue for how much they pay, and whether that's 1 or 5 or 10 or 20 is pretty critical.
Hey, DC, along that line, so just tell me if I'm wrong, because this is just the way my mind works. But when I see somebody's exit strategy, that also tells me a lot about their philosophy of life.
Yes.
And so I think there's, am I wrong about that? I mean, if, you know, and I think that you're going to tell
No,
the
you're
VC a lot,
completely
or
right that part of everything in the pitch, but in particular, the exit strategy is um, about, is this a good investment? And kind of the worst case for us, worse than actually the business failing, is that a company is successful but never exits. So we don't even get the tax write-off for it. Our money is sitting there. We own, 1% of the business or whatever. And the company goes on, it pays its executives lots of money. It's has nice offices, and we get nothing. So we need to know that your plan, if you're looking for venture investors, that your plan is to get to an exit in a reasonable time frame that will be, I'm already 60 years old. This is not the inheritance for my kids. I want to actually be able to enjoy this. So you need to convince me that this is a good investment coming out of my retirement fund for me. And that's different than like a corporate sort of presentation where it's about profits and about profitability and the idea, and once you're generating profits, then, how much is your profits per year? But venture investors, including angels, don't get anything until the company stock is sold. So you need to convince us that that's your goal. Now, that doesn't mean you have to leave the company. You can still be a division within whoever buys you. You can then have more money to, increase your dreams. It's not necessarily selling out. Or it could be, your goal is, okay, we're successful with this one. Now I'm going to do my next startup. So, it is about your personality and whether you're going to make money for us or whether you're going to create a nice little profitable business for yourself and want to use our money for that.
Thank you.
Piggybacking on that, the reason that angel investors can't accept or only get paid when the company is sold, is that a legal requirement that they can't accept dividends, or is that just the state of the art today?
That's just kind of the structure of the business, that profitability doesn't get us very much. So if you work from the assumption of, your success rate is likely to be 90% and you're going to generate, 10% profits and pay a dividend every year, I'd take that in a heartbeat, right? But the problem is the success rate is, typically 1 out of 10. So 90% are going to fail. So we need a way of getting a 10x return from that one success, and having a small dividend stream every year doesn't really help. There's also the issue of taxes, that we would pay full taxes on the dividend stream. We pay no taxes. Well, we pay capital gains, which is lower on an exit, but then if we're individual investors, we don't pay anything. So that helps. But then kind of the biggest constraint is the way the venture funds are structured. So the venture funds, and it doesn't matter to individuals, but the next round is likely to be the VCs. And the VC funds are set up so that they are liquidated after 10 years. So they need all of the investments to be out before the end of the 10 years, or else they're kind of stuck. So we're a little bit before that, but next round is going to be the VCs, and they're going to require you to have some sort of an exit in 10 years, or they're not going to invest. And if they're not going to invest, you're going to be dead at that point. So that's not good for us either.
I know we're getting toward the end, or at the end of timing here, and I don't know if there's any last questions.
Speak now.
So I think the biggest message here is don't think about you, think about the investors and what they want, and how they make money, because it is pretty risky that they're putting in money for 5+ years and just hoping they get some sort of return from some sort of exit.
Deji, you went on mute. You ask a question. You
Oh
got
yeah,
this
so
right
I'm interested, DC, because you talked so much about getting acquired. What if you heard someone talking about a public offering? Would you think they're naive? Like what? How would you talk about that?
Yeah, it depends on what they're doing. So, and kind of the limit is if you're going to go public, you need to have $1 billion in revenue or be quickly accelerating towards that. And most of the startups that are going to get in front of angel investors are unlikely to be at that scale. So if you are, and consumer packaged goods is a good example. But let's say you've invented a whole new battery chemistry. That's a tens of billions of dollars of business, and you could completely dominate it. Then your exit strategy is probably going to be IPO. There's no reason why you'd want to sell out, as opposed to like going off and competing with Panasonic. So it depends on what the business is. But most of the things, like if you're doing some cathode coating as opposed to a whole new battery chemistry, I don't want to hear about IPOs because you're never going to get to $1 billion in size. I want to hear that Panasonic is going to buy you for $1 billion because they're going to need that to make, to have competitive batteries against SK. So yeah, it does come out naive to the people who are, trying to pitch us very niche businesses saying that they're going to do an IPO. And we're like, no, you're not going to do an IPO. So you better have another plan. But, if you are working on something that is revolutionize the entire industry, then that probably is the way you're going to go.
Thanks so much. It really helps you understand that.
Good.
Well, this is great. DC, if anybody ever wanted to ask you a quick question, which means they're not going to ask you for a check, but they would ask for some advice real quick, would you be open to that?
Oh yeah, of course. Yeah, for multiple reasons. I'm part of MEIA, so I'm happy to support any of the organizations, companies within MEIA. And then climate tech is my passion, so that gets special attention from me. So feel free to reach out, and happy to help out however I can.
All righty. We can go ahead and bring this one to a close. DC, again, thank you